Okay, so that's really, just creates a bit of background into some of the rationale about why we feel that cryptocurrency and Bitcoin is a legitimate asset class to be looking to allocate, and given the macroeconomic backdrop. I'd now like to just turn attention to the investment analysis side of things. And yeah, we'll just start off very high level by looking at the digital asset ecosystem. Many of you are probably quite familiar with this, but this really is, on the left-hand side, your menu. So this is the top 10 cryptocurrencies by market cap as of 1 April.
And I think that shows us a bit of the volatility. We're now almost down back at 1 trillion again. But sure, we do understand that this is a highly risky investment.
Yes. But I think also just to point out here is, the development of the infrastructure of the digital asset space is actually far greater and impressive than many traditional investors recognize. It's a very liquid market. We can see that by the types of volumes that are moving through the various exchanges, the institutional adoption that we're seeing, and corporations that are investing into the space. Bitcoin's been around for 13 years now, which is no longer a short period of time. Any technology company that's been around for 13 years, that's a decent time to have survived in the market. And truly, if you look at the brain power and the resources that are being put into developing this infrastructure, I think it's now recognized that the digital asset space is definitely an asset class worth considering for investment. Okay, so if you've got to the stage now where you recognize or have made a commitment to saying that you want to invest in this space, quite quickly you'll realize that Bitcoin and Ethereum, for example, are not the only show in town, and that there's actually thousands of digital assets out there. So this is where our value add really starts. So where we begin the investment approach is to categorize the various assets into different categories. We do go into more detail in this, but for us, there's 5 main categories. So firstly, we've got store of value. And here for us, Bitcoin stands head and shoulders above any of its peers for that use case, just because it's been around for longer than any other digital asset. The level of adoption, the brand that's built up around Bitcoin, we don't think that it really has any competitors in the store of value category. Then secondly, you've got your platform tokens. So here we've got Ethereum, Cardano, Binance Coin, Polkadot are all examples of platform tokens. And these projects use blockchain to create the infrastructure for other applications to develop on top of. And this has been a very exciting space to invest. And obviously these projects have done very well this last bull market. Third category is payment tokens. So this is less attractive to us. So here we've highlighted Dash, Ripple, and Bitcoin Cash as 3 assets that fit into that category. They're really looking to optimize, make use of the low cost, efficiency, and speed of payments. So it's not necessarily a token that's going to appreciate in value, but nevertheless is harnessing blockchain technology, not necessarily the most attractive place to be investing. And then the fourth category is a very broad catch-all category, and that's utility tokens. Most of these projects are businesses or ventures that are looking to develop solutions on top of the platforms like Ethereum and like Binance. And here, a lot of this technology is very new. And look, because of the unregulated environment, many of these are scams and definitely not viable investment options. And we have to be very selective about which assets you're looking to allocate to in that category.
And our list is non-exhaustive. I mean, over time, you'll find that the platform coins also developing. There's Tron, Solana, lots of interesting projects coming to the market that we're also analyzing. But this is just to give you a framework of how we compartmentalize the various 6,000 coins available and knowing which ones are not those that we want to look at all.
For sure. And then the last category is asset-backed cryptocurrencies. So here, the most prevalent ones and useful for us are the stable coins. So example of stable coin is US dollar Tether. There, the price is linked 1-to-1 to the dollar. So it has a price peg. And that's tokens like Tether and USDC and TrueUSD are cash alternatives. So these are also off ramps for us where we can deleverage or de-risk ourselves of crypto exposure in a very liquid and easily accessible way. There are other asset-backed tokens like Pax Gold or Tether Gold, which will be have a price relationship of 1-to-1 to that underlying asset. But we primarily use it for the dollar stable coins. Okay, so that's just a quick flyby over almost the ecosystem that we're dealing in.
This is a very juicy part now. This is where I get very excited, because this is really now where our technical analysis and our indicators differentiate us from your traditional stock markets. There's a lot of intel we can glean using blockchain that is not available when trading normal equities and normal commodities.
Yeah, so one of the great things about the digital asset investment space is the easily accessible data sources and the sheer volume of data. There's definitely no shortage of that. And this provides many opportunities to analyze indicators to help you with your investment decisions. So I'm just showing you 2 examples here, but there are many. And we can go into very granular detail in looking into these different data sources. So essentially what I'm just showing you here is the forest. And then we take the time to actually look through the trees to find out exactly what's happening and then make decisions off that. But broadly speaking, this is an example on the left-hand side. This chart is the stock to flow reversion model. So the stock to flow model was originally created for commodity investing and trading. So this analyzes the new stock, in this case, the new supply of Bitcoin into the market, and has essentially created a pricing model based on that. And the basics here is to say if the Bitcoin price is higher than the stock to flow suggested price, that could indicate that Bitcoin is overvalued, and vice versa, if Bitcoin is trading under that price, it's then relatively undervalued. And obviously, no one of these indicators drives our investment decisions. It's just one indicator that we include when making our investment decisions. And the stock to flow model has been incredibly accurate. It does throw out some crazy valuations that many investors said were impossible. But now that we've seen some of the growth in Bitcoin, it has actually shown itself to be very, very accurate. And that's not to say that models can't break; they definitely can. But this one is one model that we found very useful. And then on the on the right-hand side is the leverage ratio. So this just shows you the open interest in the derivative market. As the space has developed, the derivative market has also developed to a very substantial degree, and there's a lot of leverage involved in the crypto markets. And when that leverage ratio becomes, in our views, unsustainably high, we definitely want to know that, and that's a red flag for us, that leverage needs to unwind at some stage, especially if it's long leverage, for example. And that's something that we will take into account in looking to take precautionary measures when leverage is very high.
Exactly, Graham. And that indicator lets us know the amplification of a particular move. So if a move is happening when something is highly geared, we know that would be a rather big move.
Yeah, and I think like these most recent sell-offs we've seen, a lot of it has been intensified by the amount of leverage. So in my view, not many traders or investors necessarily wanted to be liquidated at $40,000 or $35,000 in the sell-off a couple of weeks ago, but they were leveraged and they were being liquidated, and that just amplifies some of these moves. And look at that does add in the volatility and more risk into the market, but also if you know how to position yourself correctly, that provides good entry points. If we can be picking up crypto when there are forced sellers in the market, that's an opportunity for those that know how to exploit those situations.
We are banking on and expecting volatility, and we are trading very aggressively in and out of cash when our indicators tell us it's time to do so.
Yeah, 100%. Okay, then this is a look at on-chain analysis. So this truly is unique to the digital asset space because everything's happening on the blockchain, which is public information. Again, there's a whole bunch of data that comes out of that. And these are just two examples of views of activity on various blockchains. So on the left-hand side, you've got Binance and the activity shown by the pink area there. And in this case, this was a leading indicator because you can see this arrow showing you an uptick in activity on the blockchain, and then the price follows shortly thereafter. So this was an example of a leading indicator. The right-hand side isn't necessarily a leading indicator, but does show you or does support the price move. So this is Chainlink. Again, you can see the increase in the orange bars here showing more activity on the blockchain, and that's really supports the increase in price. So for example, if we saw an increase in price and no increase in activity on that blockchain, that could point to an unsustainable move, for example.
Which is brilliant. It's almost like you want to buy an Apple iPhone, but the day before how many Apple iPhone cases were sold. So beforehand what the demand for that particular asset's going to be. And this is all new intel which is available on the blockchain.
Yeah, and then further on-chain analysis. So I really like looking at the net inflows onto and off of various exchanges. So we see quite a high correlation between new Bitcoin arriving, especially if it's coming from small amounts of wallets, large amounts of Bitcoin. So that would indicate either institution or a Bitcoin whale depositing new Bitcoin onto exchange. And that obviously creates more supply on that exchange with the potential for that supply to be sold. So we've seen a fairly strong correlation between big inflows onto exchanges and market sell-offs. Okay, so we've got triggers that automatically let us know when there are large amounts of Bitcoin landing on exchanges. And then that just, again, is an opportunity for us to examine that quite closely. And vice versa, if we see Bitcoin being removed from exchanges, that's generally bullish activity for the price. Then on the right-hand side, you've got the miners. These are obviously very important players in the blockchain space because this is where all your new supply comes from. So if we see the miners, and you can identify who the miners are, who these different players are by their address. And there's companies that are purely in business just to identify which wallet addresses belong to which individuals or which entities. And over time, you do get quite a nice map of what the players are up to. So this specifically is for the miners, and obviously if the miners are introducing large supply into the market, that's a bearish signal, and if they are holding back their supply, then that's typically bullish for the price.
And we're just showing Bitcoin here as an example. So we would analyze all our crypto assets where we can derive this information. We would look at indicators like this for each of them.
100%. Okay, then GitHub is also a great place for information, and we do have the skills in-house from a development and coding point of view to actually do deep dives into various projects and their activity in developing the software that underpins this whole industry. So here you can go look at a specific project, let's call it Chainlink, and you can go and see how many developers are on this project, the number of software code commits over specified periods of time, how concentrated are those code commits to a certain number of individuals. Obviously, we want to see decentralized contributions and diversified contributions to the various projects. We think that provides a more sustainable and more attractive investment project. And then determining how concentrated those code commits are to specific developers. But yeah, this type of insight is just another level of analysis that we can do into the various projects.
To add a little bit of color there, our tech team includes software engineers and guys that deeply understand code and the projects that are being built. So they're able to give a lot more intel than Graham and I as investment professionals would understand and how a particular protocol works or what its parameters or hurdles may be in achieving its purpose.
Yeah. So one of the famous descriptions of Bitcoin or cryptocurrency is to say it's everything about finance that you don't know, combined with everything about technology that you don't know, fitted into one asset or one element. And it does have some truth in it, that you need skill sets both on the financial investment side as well as the tech and software development side, really to make a holistic picture when it comes to assessing investment opportunities. Okay, and then this slide shows the market cycle. So I've mapped this out around the halving periods. So for those of you that don't know, new Bitcoin is introduced into the market on a predetermined basis. And approximately every 4 years, the supply of new Bitcoin halves. So if there was 100 Bitcoin per day being introduced to the market at one point, then after the halving, there would only be 50 new Bitcoin entering the market thereafter. And obviously, more limited supply is bullish to the price. So it's a deflationary effect. And then just compare that to your fiat currency, which is being printed almost at a exponential rate. and yeah, for me, there's nothing else to take away. It's just that concept that this is a deflationary asset compared to our fiat currencies, which are inflationary by nature.
Yeah, just on simple supply and demand, it just means that our demand is growing at an increasing rate and the supply is growing at a decreasing rate.
Yep.
And as we grow up the adoption curve, the demand for crypto and the good crypto that actually have a real purpose is pushing the price up.
Yep. So here, this graph shows you the black lines, which are the halving periods. And like I said, this happens approximately every 4 years. And you can see the price dynamics have been fairly consistent around these periods. So yeah, they say in investing that price action doesn't repeat, but it does rhyme, and we can definitely see some rhythm in this chart. So let's go to the left-hand side. You can see just over a year before the halving was the start of your bull market, and typically that's a fairly or relatively slow accumulation type period. Then after the halving, you get a more aggressive uptick in price action, and 3/4 of the way through, signified by the red flags here, we have consistently seen a significant sell-off. So this is on log scale, but this first drawdown was about 50% in the second cycle. So this was 2017, which most of you probably remember the euphoria around that period of time. There was about a 40% drawdown around that red flag. And the sell-off that we're having at the moment, in my view, is where we are in this current bull market cycle. And we've had more than a 50% drawdown. It's been approximately 55% since the all-time high. I think a lot of that was accentuated by the amount of leverage that is now in the system. But in my view, in the view of the investment committee, this is, we're only 3/4 of the way through this current bull market cycle. And yes, we can obviously be wrong, and cycles can change, but that's what needs to happen for us to be wrong, is that this cycle needs to fundamentally change, needs to break. So if this cycle holds true, and I've got haven't got any reason to believe that it is changing at this point in time, then we expect the top only to occur later this year or even early next year. And it's our expectation that we could see prices north of $100,000. And obviously for investors entering the market now at $35,000 to $40,000, in our view, that's quite an attractive entry price, given where we think the market can potentially go. Okay, so that's some insight into our analysis. I'd just like to take you through how we now actually implement this in our strategy. So, strategically, as I've described, we feel that cryptocurrency is the most attractive asset class at this point in time, given the macro economic situation, as well as the technological advances in this new asset class. And this is where we've really focused our attention, and obviously we've got the skill set to complement that. Tactically, what we aim to achieve is to identify when we expect periods of uptrend, and in periods of uptrend, we want to over allocate to altcoins. So altcoins, for those who don't know, is anything outside of Bitcoin, and altcoins are generally more volatile and have more upside than Bitcoin in bull markets. So that's how we are looking to outperform just holding Bitcoin in your own wallet or in an ETF when the ETFs arrive. That's how we're looking to outperform to the upside. Then on the downside, this is where we are looking to allocate to cash or stable coins to minimize the drawdown of these sell-off events. And just to give you some insight into our track record so far. So the original big sell-off that we've had in this bull market was from approximately $50,000 down to $35,000. So when we were at $50,000, we were 60% into cash. So we took less than half the drawdown in our portfolio for that initial sell-off. We then consolidated and moved sideways for a relatively extended period of time. And only this week have we sold off fairly aggressively outside of the consolidation structure. There we were in approximately 45% cash. So again, we've managed that drawdown a lot better than the market has. And yeah, over time, if you compound those type of activities, we are expecting to deliver significant alpha over purely holding Bitcoin or even a basket of currencies. So that's really how we're looking to generate alpha and obviously manage the risk of client investments.
And just to support Graham on that, what also happens is in times of market stress, you'll find that Binance crashed and Kraken crashed and you can't log in to trade your crypto. But usually what happens is the front door crashes and you can't actually log into your system. Our system has an API connection directly into this, the core systems of the exchanges that we trade. So we haven't had any system interruptions when these market stress times happen because we're able to trade directly from our system without going through their front door. It also is important that when there's a time of market stress, we have planned multiple exits out of a long crypto position into fiat in multiple currencies or into stable coins, and can even possibly short a crypto position if needed, if we can't hedge out in a different format.
Yeah, 100%. And I think that this is what your what your average retail investor doesn't have access to. They don't have access to multiple exchanges, derivatives, markets where you can take short positions if there are issues with exiting your position through a single exchange, as an example. Then the third source of alpha is arbitrage. So we are connecting to multiple exchange accounts, and obviously in the crypto market space, there are price inefficiencies fairly extensively across the board. And this is where the software provided by REL Technology has a long track record of producing positive arbitrage returns using the algorithmic trading.
And we're still seeing the investment solutions slide. Just are you jumping across to the arbitrage slide? I haven't come across it.
Do you want to go down to arbitrage?
Oh no, sorry, no, sorry. Okay, yeah, we'll get.
Yeah, we'll get to arbitrage in a bit more detail, but just on a high level, this is another source of alpha that we're looking to add. So it's not a core focus, but it is an area where we can add alpha. And then lastly is asset protection. So here we are only using blue chip exchanges. We're using custody providers. Like I said, we've got multiple exchanges, deep liquidity, especially in times of market stress. And we are making use of the proprietary software when it comes to the movement and transfer of assets in this environment. So we're really taking that risk of investors holding their own private keys and passwords, etc., off the table and taking it in-house to an institutional level security and protection standards. Okay, so this is just to give an idea about how the portfolio is actually constructed. So like I said, Bitcoin, in our view, stands in many ways head and shoulders above the rest of the market. So we are looking to hold a core position in Bitcoin. If Bitcoin is the king, Ethereum is the queen. We have a lot of positive expectations about Ethereum. It's a very robust network that's been very well adopted and has many users and a lot of value transacted through Ethereum. So it really is, in our view, almost the queen of the digital asset space. And there we're looking to hold a secondary position. Anything outside of that, in our view, really is a short to medium term, more speculative position. And that's where we're looking to allocate to assets outside of Bitcoin and Ethereum to give you that alpha during uptrends.
And that decisions come from many interviews we've had with multiple asset managers and custodians about which assets they are putting on their roadmap. So we're talking to Standard Chartered Bank and large global custodians to understand what is their roadmap in terms of which cryptos they intend to put on first. And the large majority are going firstly for Bitcoin, then Ethereum, and then others. And as we become aware from our interviews with the financial market, we then will know which assets are getting more of the mainstream adoption.
100%. And then, yeah, like I mentioned, cash and stablecoins is obviously our defensive play. So that's where we're looking to reduce the exposures, firstly, to those speculative alts, movement into cash, and then obviously, if need be, we can then draw down on our Bitcoin and Ethereum positions as well to provide extra protection. And we do have within our mandate the ability to go 100% into cash and stable coins. Obviously, that would need to be a fairly extreme bearish event, or at least we would expect a very bearish event in order to do that. But we have the mandate to go fully defensive if need be. So and this just adds a bit more color into how this portfolio would change depending on the expected market conditions. So like I said, an aggressive portfolio would include a number of smaller altcoins and maintaining your core position in Bitcoin and Ethereum. Your moderate portfolio would then trim down those altcoins positions, add more cash and stablecoin. And that's not only just to protect on the downside, but that also just provides you dry powder to buy in at more attractive prices if the market does dip. And then finally, your conservative portfolio would obviously be made up primarily of cash and Bitcoin and a bit of Ethereum.
These are all illustrative portfolios. So we've got a more detailed portfolio than that. Maybe at the end, if we have time, we can show you a little bit.
Okay, and this is just to highlight the benefits of active asset management. So obviously, we've seen a lot of institutions and corporates put up their hand and say that they are investing in the space, which is all good and well, when the price is moving strongly to the upside. But like we've seen recently, it's not a comfortable ride. Taking more than 50% drawdown in that position. So this is really where we think our primary value add comes in, and that's to protect capital during downside moves.
Cushion the blow just a little bit.
Sorry, Bilal?
Cushion the blow just a little bit.
Yeah, 100%. And look, we're not claiming we're going to get this right every time. We definitely can't remove all the volatility, but in our view, we are expecting to add significant value to clients' portfolios through an active asset management approach. And then I've touched a little bit on the algorithmic trading, specifically focused on arbitrage. We can connect up to 10 different exchange accounts through the software, and those. And essentially what the algorithm does is consistently look to identify price inefficiencies. So it's as simple as identifying that Bitcoin is cheap on one exchange, more expensive on the other exchange, and implementing a instantaneous transaction to buy on one exchange, sell on the other exchange. And this mechanism is risk-free in its mechanics. Obviously, no investment strategy is risk-free, but as a mechanism, arbitrage is risk-free. And Arel has spent 4 years developing this software. And trading.
Definitely a core competence that we have delivered on.
100%.
I think trading in excess of $100 million in arbitrage at the moment.
So the software has been stress tested and has a very good track record behind it. And so this is just pointing to the algorithmic trading part of it. But this is the same software that we are leveraging off and essentially managing our assets on top of, which has got a track record, is tried, tested, and we're very excited to be to have access to this software provided by Arel to manage assets in this space.
So if I can just jump in, if I may, grab quickly and Bilal. So to obviously state the obvious, if I may. So the Stewards Arbitrage Fund, US fund, that is officially live and running. This is the strategy that is the core strategy in that fund. So during the sort of question and answer session at the end of the presentation, you can ask more questions on this if you like for those guys from the USO on this call.
Perfect. Thanks, Glenn.
Thanks, Glenn. Okay, and then in terms of portfolio performance, so as you know, this is a new product, but we have been running this strategy in pilot since October 2019. These are not back-tested results. These are results achieved in a real account, and they've been very good. So as of October 2019, if you had invested $100,000 into the strategy, that would have given you a valuation just shy of $1 million, the 20th of April, 2021. And for illustrative purposes, if this is, let's call it a 9 or 10x return, investment in Bitcoin over the same period would have given you a 6x return. Okay, so it's still nothing to be ashamed of there. But what we do want to highlight is that obviously this is an outperformance of over 30% that was achieved in our pilot portfolio compared to just buying and holding Bitcoin. And obviously what you can see is there's a couple of drawdowns along the way, but nothing significant. We need to extend this picture further to include the most recent price activity, which has obviously been very bearish, where Bitcoin has given back quite a big chunk of its market cap. And there, like I mentioned earlier, we've taken that drawdown significantly better than the market itself. And that's an illustration of the value that we're adding in the active asset management activities. So, and then just to highlight the fees, so management fee of 2%, administration fee that essentially is to IAL, the custodian, of 0.45%, performance fee of 20%, but that only applies to above a hurdle rate of 10% on an annualized basis. So essentially the first 10% of return, we're saying is 100% accrued to the investor, and only after we've achieved that 10% do we then share in 20% of the performance, 20% of the performance thereafter. Okay, Glenn, I'm going to hand over to you to introduce stewards and some of the guys on your team.
Graham, thank you. So we've already touched on Bilal, but Pete Featonby Smith and I are the original founders of the group. We go back, as I said earlier, well over 20 years, 2 decades. And Brad Kritzinger, he's been with us for cheapers now 16, 17 years. And we've got an incredible amount of experience in the asset management space. Been money managers for this full period, and even prior to that, 5 years of London experience for 2 investment banks. So it's a solid team and still very much active in the financial world. Thank you.
Thanks, Glenn. And so that brings a lot of the structure to how we approach crypto assets. Richard, I don't know if you're still there. We're going to jump across to you in a couple of minutes if you want to tell us about IAL, or we can handle that.
I'm here.
Cool. Okay.
Do you want to chat about the REL team, Bilal?
Yeah, so I also serve as chairman of REL, very exciting team. Nick Allen is our CEO. You've met Graham. Jeff is our CTO. The team are highly experienced professionals coming out of PFK Electronics, which is a business that used to develop telematics to switch off all the BMWs in Moscow from South Africa. We've got guys that did the security and looked after Micro Gaming, which is one of the largest global online gaming businesses, which manages hundreds of millions of dollars of payments. Jeff also built a software which was sold to big businesses like Unilever. So a very, very high caliber team. Andre Berg, who's not on the slide, ex-Microsoft. And of course, Graham, who I don't need to tell you how clever he is now that you've met him. But Graham, highly qualified, highly experienced. But Graham and I often feel like the silly boys amongst our techie friends that say all sorts of complicated things that we very often take about a week to catch up on what they mean. But it's a really great team. It's a good blend of tech and asset management and financial experience.
Great, thanks, Bilal.
Glenn's touched on Stewards Investments already, and Stewards Investment Capital licensed in South Africa, Mauritius, and the US, running 20+ years. I'm just cognizant of time. Maybe we can just jump across. And then the Arrow Technology Platform, which is a proprietary software that we're using to power the intel of the arbitrage in rands and dollars, and also the intel that we use to do the spectrum trading and access to markets very quickly. And there's a lot of bespoke proprietary algorithms that are used to poll and derive pricing from markets faster than what you can see if you try to trade directly on those markets. Our role offers portfolio management, treasury management, brokerage. We actually create the liquidity on many exchanges. So what happens is often if we're not trading on a particular day, you might actually get a phone call the next day from the exchange to ask us where we were, or why we were a bit lower that day. So we are noticed by the exchanges that we deal with. Jeff and team have built very interesting algorithms, each of which have astronomer names and scientific names that they're very passionate about. You've got Bohr and Aristotle and Copernicus, and they're very passionate about the amazing algorithms that they've built. And then obviously there's remittance and collateralized lending, which are easily fitted between the capabilities that we can do. But at its heart, the Aral software is a software engine which can see the price of an asset, being a digital asset, in multiple places, and is able to derive the price movements over the next few seconds of that particular asset, and able to leverage that price inefficiency or trade that price as fast as possible. And over the time that we've been running this platform, we've sped up from about 800 milliseconds per trade to about 27 milliseconds per trade at the moment. And I mean, it's all a race to speed and efficiency and getting a cost right to get these trades right. Graham, let's jump across to the next slide. Richard, may I hand over to you quickly to explain to us a little about international assurance. International assurance for the Mauritian product acts as the custodian, separately holding the assets that stewards will manage. Richard is the director of international assurance, so just hand over to him to explain a bit more about the business.
Thanks, Bilal. Thanks, everybody. So yes, international assurance has been around in Mauritius since 2009. I came to Mauritius in 2003, so I'm part of the furniture here with my partner. And we bought this insurance company in 2015. It's not a traditional insurance company like you would understand most of them. We do traditional business, your life insurance business. It was created as an offshore insurance company, so everything is dollar denominated. We do issue life policies, etc. But the bulk of our business is actually in wealth structuring. So people are using insurance policies now to structure their wealth, much like you would use a trust. And that makes a lot of sense for a lot of good reasons, which we can go into later. But a niche that we discovered a couple of years ago that we were able to do as an insurance company is to create and administer funds for asset managers. We've currently got in the region of about 85 funds. And we run those exactly like you would a traditional collective investment scheme. So we act as the custodian. We get independent pricing from various places wherever that fund is being traded. We unitize it on our system, and our clients have all got access to valuations online. They can see all their transactions, so it's a completely transparent process. There's nothing, they can literally reconcile it down to the last cent. And we've been talking to Aral and to stewards for a number of years now. I've known Bilal since he came to Mauritius, about setting up something to, yeah, sometimes, about formalizing their managed solutions for clients into a fund structure, because it gives clients a lot more comfort that there's a third party who's actually overseeing the investments. And to do that, what we did is we created an ecosystem amongst the exchanges where all the assets are actually owned by international assurance, not by Aral and not by stewards. So they've got access to the assets only so far as to trade them into different investments and put them in cash, etc., and do what they do there. But they can't actually externalize those assets without international assurance being involved. So because it's a fund structure, the money goes via a policy. So each client coming into it would open a policy with us. That money would go in, or the coins would be received. We would then transfer that into that ecosystem that we've created for them. They would then trade it. If there's a withdrawal or a redemption request, that redemption request gets routed via us, and we would tell them to create the cash for that redemption, which they would do, and then we would push the button and actually externalize it, and would go back the same route that the money went in, ending up ultimately in the client's bank account. So yeah, we're able to receive coins, and we're able to transfer coins back should the client wish to redeem, and not redeem in fiat, but rather in a coin. So yeah, it's a very flexible, and it makes a lot of sense from a client's perspective.
Fantastic. Thanks, Richard. And all of that is audited by Ernst & Young, and funds under administration are in excess of $1 billion. And the business has been around for a long time, and you benefit from all the security and protection that avails. Graham, can we?
Yeah, excellent. I'll finish off.
Sorry, can I just jump in there again, just for the sake of to avoid any confusion for the US audience? That structure and insurance wrapper, if you like, is specific to the African region, and won't the US version will be a US fund and not an insurance wrapper. It would be very different, but same strategy. Thanks, guys.
Thanks for clarifying, Glenn. Cool. Okay, guys, I've got a couple of questions in the box here. Graham, may I jump over to questions? Would you like to add anything more?
Yeah, I'll just add, my thanks to everyone that joined today. Thank you for your attention, and yeah, I look forward to your support. Thanks a lot.